we are in the process of trying to turn community into a verb. We have something we call a community personal finance. But basically, when a deal comes in, we community the deal, meaning our community, the members of our community, they look at the deal, they analyze it, and they talk and decide whether, everyone makes their own. We're kind of a DIY group where everyone makes their own decision, but everyone's helping.
This is the Yield Coach Show, episode 39.
Hey everybody, this is your coach Ian Brown. A few announcements. Yield Coach Capital has opened its doors to investors looking to multiply their money while working with yours truly and our varsity investment team. We recently closed our 170-acre Gainesville, Florida industrial tract, and our limited partner investors are on pace to make 2.5 times or more on their money. That opportunity is gone, but don't miss the next one. Be sure to join our investor list and never miss a deal again. You can join our investor list by the portal, which is in the show notes of this podcast. It's in our Instagram bio link, and you can also do it at yield-coach.com. If you join our investor list, we will get you the free gift, 107 questions to ask a deal sponsor, and a discount to our Employee to Entrepreneur video course, which is packed full of information and case studies to kickstart your investment success. Now is your time to take the field.
I'm your host, Ian Brown. Every episode, we bring you dynamic entrepreneurs, real estate investors, thought leaders, and inspirational guests ready to open up, share their story, the good, the bad, the ugly, so you can learn lessons, gain advantages, and accelerate your success. I am very excited to be joined today with Jim Pfeifer. Jim has an interesting resume. He is one of the founders of Left Field Investors and host of the Passive Investing from the Left Field podcast. He's invested in over 45 passive syndications and all kinds of asset classes. And he's also worked as an underwriter, a high school teacher in a former life, a financial advisor, and now he's a full-time passive investor. He might be the first full-time passive investor we've had on the show. Jim, welcome.
Thank you very much. I appreciate being on the show.
It like most of us, it's a meandering and wandering journey to get to this kind of like investor status, and you got to earn it and get your stripes along the way. How did you get into passive investing? I see this financial background, but it's a big jump. It's a big jump to go from being in underwriting and teaching and advising to being a full-time passive investor. So tell us about yourself, your background, and a little bit of your evolution.
Yeah, so I was always a finance guy. I was a finance major in college, and I was really always interested in numbers, stock market, all that stuff. So my whole career, I'd been investing in the stock market. As you said, I was a reinsurance underwriter for a while. I was an accounting finance teacher in Columbus Public Schools here in Ohio, where I live. And then I became a financial advisor. And at the same time, I was kind of transitioning to become a financial advisor. And what they do is they kind of just break it down and teach you about money like you don't know anything. And at the same time that was happening, we had a house that we had built, and our old house we couldn't sell, right? It was 2008. So we had this house we couldn't sell. So we ended up renting it out. So at the same time, I was an accidental landlord, right? I didn't want to have this house rented out. I was learning, about money from the financial planner world. And the more they taught me, the more I realized, wow, all this paper asset stuff that you're teaching me doesn't make much sense, because I'm seeing over here what real estate's doing. And at that point, a few years passed, and I was going to sell the home because I didn't like being a landlord. Didn't like any of that. And my realtor said, well, look, you have this house paid off. Why don't you refinance it, and we'll go out and get you 2 more rentals, and I'll manage them for you. And I thought, oh yeah, I've seen what the cash flow does and some of the advantages of real estate, but I just didn't want to be the manager, and I didn't know anything. I didn't know you could hire a property manager. So we did that and bought 2 more houses, and it was off to the races. And pretty soon I realized that I wanted to be in real estate, and I couldn't do that as a financial advisor because, one, I couldn't recommend real estate to my clients, and I always prided myself in investing in the same things that I was recommending to them. I didn't have the licenses to do it, and I didn't get compensated for it. So eventually I bought more active real estate. I bought some multifamily properties, a bunch of single family turnkeys, and kind of slowly transitioned out of the financial planning into full-time active real estate. And then I realized that I wasn't very good at being an asset manager, right? I was none of the properties cash flowed how I expected them to because I was constantly battling with property managers. I thought I was passive because I wasn't doing anything, right? I was just buying properties and having someone else manage them. Well, that is active. Some people think it's passive. I don't know how you make it passive, but luckily for me, I was in a time of the market where even a poor asset manager was making money. So then I went to a real estate guy's seminar where they were talking about syndications. And I went there thinking I was going to be a syndicator. I left there knowing that I wanted to be a passive investor. I didn't know that was a thing. I ended up selling all of my active investments and investing it in passive real estate. And, along the way, I started a community, Left Field Investors, because I wanted to start a small mastermind, 12 people in Columbus, Ohio. We're going to go out to dinner once a month. First meeting, March 18th, 2020. That was when the pandemic shut everything down. So we went online, started Zoom meetings, and now we're a 1,300 member community completely by accident. But
Wow.
now I'm a full-time passive investor, and I also run and manage Left Field Investors, the community of 1,300 passive investors.
Interesting. That's are you running that as, it's kind of a narrow question, are you running that as like a fund of funds model where you will pool through your community and go into deals as a fund of funds model or an SPV model where you'll go into another person's deals, kind of like a fund manager, to say it plainly?
Yeah, not exactly. So what we do, and there's the kind of a caveat there. So we're a community that provides education, a network, and deal flow to our members. So we just started about a year ago offering the deal flow. And the way we do that is we try to be very unbiased as to the deal, and we don't recommend a deal. We don't get compensated as capital raisers or fund to fund or anything like that. But we allow our partners to present deals on our platform, to our community. And we do sometimes put together these single purpose vehicles, SPVs, through a company called TribeVest, where they open every deal webinar that we do as Left Field Investors. They open up an SPV next to it, which allows us our community members to diversify, get into more deals, lower minimums. And also, a lot of times the operators will offer enhanced terms if you invest $500,000 or $1 million. And so we can aggregate that capital in either through TribeVest or just aggregate it directly and provide better terms for our members. So we kind of do that, but in a very unique way, I think, with our partner TribeVest.
That's interesting. Yeah, because it does sound like a fund of funds model. If you have TribeVest, people come in at lower minimums, you negotiate better terms by bringing in the SPV at, say, the 500 number or whatever it is for the better waterfall structure.
The difference is we don't get compensated. We don't take a piece of it. It all gets passed on to our community members. We make our money by charging our partners for access to the community. So it's a little bit different because we're not the capital raisers. We're not taking a piece of these deals. And that, our goal there is to remain as unbiased as we can so that our community knows they can come to us and they can see a breadth of deals rather than kind of getting, sometimes when you do the fund of funds, you're only concentrating on 3 or 4 operators, where here we can provide them with a lot of deal flow from multiple different operators.
Interesting. So it's the operators paying to get the attention and the eyeballs and to get their deal into your platform. You stay kind of like this neutral arbitrator of the whole thing and let them do their own decision making and underwriting. Do you guys are there any positions? When I say positions, like analysis and underwriting and, kind of thumb upping, thumb downing these opportunities? Because obviously you have paid general sponsors or developers or deal makers bringing in opportunities to your platform. I'm just kind of curious. I'm not trying to needle you, but how do you, since they're coming in with a paid opportunity, you just put it out there and let the community vet it and underwrite it and decide?
Kind of. And again, it's all, shades of gray, I guess. We are in the process of trying to turn community into a verb. We have something we call a community personal finance. But basically, when a deal comes in, we community the deal, meaning our community, the members of our community, they look at the deal, they analyze it, and they talk and decide whether, everyone makes their own. We're kind of a DIY group where everyone makes their own decision, but everyone's helping. So Left Field Investors, we don't recommend deals at all. But our community will get together and analyze it, them together. And we don't just let anybody come onto our platform and present a deal. There's, we talk to the sponsors and we get a feel for them. Some of them we know very well. Some of them are what we call preferred partners. And of course, we allow them to present. And then other partners that we don't know as well, we would talk to them. And we're not screening them necessarily, but we're making sure as much as we can that they are, legitimate operators. And then we let the community kind of vet the operator and the deal together. And that's where the community, all the people work together to help each other. And that's the whole point of our community, to be honest.
It is a unique model like this, like kind of investor club. So if I wanted to bring, like a yield coach capital deal, we closed a syndication 3 weeks ago, and we raised, it wasn't an enormous raise. We raised $1 million of LP equity with 2 classes, and really good deal, high margin, but didn't have a distribution component because it's this land breakup play of industrial in Florida. And so would you guys look in certain geographic concentrations? I'm kind of pivoting now, like from geography to asset class. Who can bring in? What's the? I know you said you vet them on their track record, but what do you like to bring into your platform?
We're pretty agnostic there. Our community is less interested in development type things than they are in just cash flow. A lot of people are working to build up their cash flow so they can be independent of the W-2, reduce the W-2, eliminate the W-2. So cash flow is a focus. There are some in our community who do some development and some just straight appreciation plays, but mostly it's cash flow deals. The market, we're interested in any market that makes sense. We like to diversify by asset class, by market, and by operator. And that's kind of the philosophy. There's other ways we like to diversify as well, but that's the standard. So the deals that are coming to our community are coming mostly from operators that we already know, like, and trust, and then others that we are just meeting and getting to know. And they could be operationally, they could be investing in any market.
And just to dive a little bit deeper on this. So here comes the operator partner that gets the deal into your community. Who's setting the terms of this? Of the waterfall, the debt structure? It's not really debt, the equity structure. Is it, let's say, we'll just use the same example. Yield Coach Capital brings in some industrial play. Like I said, my deal is a growth, not a distribution play. All the pref is going to accrue, but you had a really good multiple. So, right, kind of classic development, high multiple, no cash flow. Yeah. Do I set my terms with you, or is it kind of almost like out for procurement? Out for bid kind of thing. How does that work?
At this point, it's the operators. They set their terms. Some of them offer us enhanced terms. Like, if we get to $1 million collectively, they'll give us a better share class or some extra kick at the back end. Others aren't able to do that or don't want to do that. And so it just really depends on the operator. We don't go to the operators and say, hey, we need these terms. We say, look, our community is going to respond better if there's an opportunity for enhanced terms. And if there isn't, you might not get as much investment, and then it's your choice. We are finding currently that with all the market changes, that it is harder to raise capital. It's harder to fill these deals than it was a year ago when we started. In just last year, for the second half of the year, and we weren't even doing it on purpose, really. Our community invested over $22 million in the deals that we presented, and that was kind of at the very end of the peak last summer, right? And so it's a little bit harder now to fill those deals, and so operators are actually coming to us more because they know they can get a chunk of capital from left field investors, members, but it's not, the chunks are smaller than they were 12 months ago, for sure.
Well, first of all, congratulations on $22 million in funding through your you call it the tribe, the left field investors. What was I like that.
Yeah, well, TribeVest is another company. It's a very close partner of ours, and in these deals, some invest directly with the operator, some invest through the single purpose vehicle that TribeVest creates. So we do both. Mm-hmm. It's confusing until you completely understand it, I guess.
Well, no, I think it makes sense because especially with negotiating low minimums to your community and then you're meeting high minimums or, B class, whatever, however they put it in there, in their
Right.
syndication. I totally understand that. I think what's atypical, which is interesting, is you're not getting like a fund management fee. You're not doing some
Right.
kind of a split. So obviously, there's fees coming into the developer or the operator. Now, my question to follow up on that, your community members, a lot of these deals are 506C, which for the audience, think the C of accreditation. That's how I remember it. So, your accreditation, accredited guys. So 200K single, 300K married for income, or net income of $1 million. Net worth of $1 million without your primary residence. So do your members meet that composition, or are you able to, bring on deals that would allow an unaccredited investor to participate?
Yeah, our community is made up of both accredited and non-accredited people. The nice thing about the non-accredited with this approach that we're doing now is, we have one operator who does 506B, so he allows 35 non-accredited members, but he only accepts the ones that give the most, that invest the most amount, the highest amount, right? So if you come in on his deals at the minimum, which I think is $50,000, you're not going to be able to invest as a non-accredited member. But so what we do is we put this open tribe together so that it's a single purpose vehicle, right? It's only investing in this one deal. So now if accredited investors invest in that or put money in that deal, and they can put in, instead of 50 grand, they can put in 10,000, right? But that single purpose vehicle is going to be one of the top 35 non-accredited investors, because we'll get, $250,000, $500,000 in that vehicle. So now a non-accredited person who couldn't get in that deal at all now can get in for a lower minimum. So it's really a great way for non-accredited people to get into deals. But also there's deals where the minimum, we're seeing some institutional quality deals where the minimum is $500,000 or $1 million. Well, most people in our community aren't going to cut one check for that, right? So again, this open tribe concept allows us to pool our capital and maybe get into some institutional quality deals that otherwise we just wouldn't have access to as individual LP investors.
I like that. I've thought about most of my deals over the past 7 years have been my own funds, private or hard money, or one partner. So I did just close a syndication, and I've thought about, since closing that, I really enjoyed it. It was more, that's a whole side story. It was a lot of work, but it was rewarding, and we got a great deal over the finish line. And I've been thinking about ways to get more people involved, because the accreditation standard, especially if you're working with people 20s, 30s, early 40s. A lot of people might get there depending on their, on their lifestyle and degrees and trajectory, but a lot of people won't, or they won't for so long that they're nearing retirement by the time they hit the net worth, and they maybe never hit the income. So I'm intrigued by your model as a way to get regular folk, that have an interest in investment into deals through your SPVs, and hit some of these, especially when you mention pooling the money, as long as it's a 506B, so non-accredited, and getting into some institutional quality assets that, or by and large, you don't have a chance. If you're, school teacher, actually, we were both school teachers at one point. If I managed to squirrel away $10,000 back when I was teaching school, which I don't think I ever did, but if I did, that would have been wonderful. Let's say I was like, well, what do I do with this? I would have been thinking about silly things like a CD. Although a CD now is not as crazy as it used to be. But these things that have almost no return, savings, right, or, and so to be able to go into like maybe an institutional asset class with $10,000, get pooled and get into a deal I couldn't even touch. I like that. Because part of I want to walk the walk on the mission side of what I'm doing. And part of that is through education, like this podcast. I did create an online course, more for your employee to entrepreneur. That's literally what it's called, but like the evolution of like the younger professional, kind of college, post-college, up to, it's hard to put an age on it, but let's say maybe 50, where you still wouldn't be afraid to reinvent yourself. And then think about, how can I get people into deals? Because I like when I read your bio, I'm like, full-time passive investor. I've had countless investors on the show, but to truly be a full-time passive investor, you need to have quite a bit of money at work, or you live like a monk, or both. But it's like, the amount of capital you need to have out. We kind of know the general prefs are usually 6 to 8%, sometimes quarterly. So it's like, if I'm going to live on that, with a family, and you have a decent amount of money out there. So it's a good goal, but it's not where a lot of people are. So, right. I found that really intriguing, especially with the fact that you started, high school finance teacher, financial advisor, and then you just grew up, right? Now you're advising an entire community of over 1,000, and you found a novel or unique way to get people into deals that are not accredited at a price point that is generally unattainable. So I'm going to golf clap so I don't blow up the microphone, but I think that's really cool that you did that.
Yeah. And I think, we're a little bit similar. And, one of the missions of Left Field Investors, and this wasn't intentional at first, but it certainly is now, is if you walk out your front door and you want to talk finance with your neighbors, right? Personal finance, they're going to be talking about their 401ks, the interest rate on their mortgage, their IRAs. And then, I'm going to come in and say, well, have you thought about real estate syndications? And they're going to be like crickets, and they're going to think I'm crazy. And so finding other people to talk about this is difficult. So that's the reason for the community. But then as the community grew, my passion as a financial advisor was also, I wanted to not just hit the normal, wealthy Wall Street people who are already, have financial advisors knocking on their door, but I wanted to go to my old school teachers, right? Just the regular people. You said it, regular folk. And so with Left Field Investors, that's one of the things we're trying to do is most people don't know that this is possible, right? And this is where we veer into what we call, sorry, my mind is blanking. Personal finance, right? There's different kinds of personal finance. There's conventional personal finance, which is the Wall Street. Then there's alternative personal finance, which is what we do. And then what we're calling community personal finance, right? And the thing is that Wall Street stuff is easy. Everyone knows how to do it. You just open a brokerage account, throw some money in, or you take money and you put it your 401k. Everyone knows how to do that. It's easy. It's not scary at all. But let's be honest, the returns aren't that great. And, fees are eating it up, and people just don't understand the difference between average return and actual return. And so you're not really, I don't know anyone who became financially free by investing in the stock market, right? You either have to buy a business or be in real estate, in my opinion. That's the way most people build wealth. So then, okay, let's do that. How do you do it? Well, then you're in the alternative space, right? The scary space. Why is that scary? Because there are, I read somewhere there's over 20,000 different individual private placements where there's only like 3,000 or 5,000 stocks or something like that, right? So not only there's so much more, but there's very little regulation compared to the stock market. There are 506Cs and SECs involved, but it's scary because no one else is doing it. It's hard. You have to send wires for $25,000, $50,000. I mean, all of it is scary and hard, right? But the returns are better. And if you do it right, you don't pay taxes. So it's definitely the place you want to be. But how do you do it? Well, that's where community personal finance comes in, right? Because if you take community personal finance is taking the alternative investment world and putting community to it, having people that can help you, that you can talk to. So now it's easier, it's safer, you feel more secure, you're more confident. One of the things when I first started in this, I didn't know anybody else who was doing it. And I was like, oh my gosh, I'm wiring 25 grand to this guy. I don't know what's going to happen to it. And I met another guy, Steve Sue. He's one of the founders of LFI. At the time, I didn't know, we hadn't started it yet. And he told me, hey, I'm investing in the same operator as you, the same deal, in fact. And the level of relief, he even saw it on my face. Like, okay, here's a doctor, smart guy, and he's doing the same thing I am. So I felt confidence. So what community personal finance gives you, it gives you confidence, it gives you education, it gives you a network. And finally, through Left Field Investors, and there's others that do it, it gives you access to deals. And, back to alternative investing access, most of these deals are hidden, right? They can't advertise them. So how do you find them? So all of this led us to kind of, with TribeVest, we're working together to teach people that community personal finance is a thing. You can get into these deals for less money than you think. You can diversify and get into more deals than you think. And it's not as scary or hard if you're doing it with a group of people that you know, like, and trust. And that's why I tell people, if you're going to be a passive investor in real estate syndications, you absolutely need to join a community. It does not have to be Left Field Investors. Obviously, I'm biased. I think we're the best community out there, but there's others. I'm a part of a couple others. There's other great groups. You just need a community if you're going to be successful in it. That's what I believe. That's my rant.
No, it was awesome. I'm spellbound. I'm just like, okay, that's it, everybody. All right. Yield coach out. No, that was awesome, Jim. And God, it's like fun. It's what, the really piercing things, like you just said, like they're almost self-evident, but you haven't thought of it first. So it's like, for you to say that, it sounds like just like common sense as you say it. We all have our different paths. I have appraisal, brokerage, law, investment. So like mine was like somewhat linear, although in my mind it wasn't. I feel like I was all over the place till I finally landed as like a full-time investor. Not full-time passive, more of the active side. However, man, as you say it like that, for someone to get my experience, let's be honest, it's probably not going to happen. So, and that's not to brag, it's just unlikely. And it was a lot of time. And I don't even know that I would recommend somebody to walk and jump on the stones that I hit to get across the river. What you're talking about is a bit of it's like a communal cheat code, like a hack where it's like you can benefit. It's so hard. People are like, how do I find mentors? Where do I learn this? And luckily in today's day and age with podcasts, books, audiobooks, YouTube channels, some social media, you can actually learn a lot, but it's almost like the paralysis of analysis or like overstimulation sometimes. And I think you end up with a group of people that are just as hungry as you had, 20 years ago before these forums, but they're like overwhelmed with information. Where you get into a community like yours, you have all these different brains to kind of analyze things. So it takes all this chaos and kind of distills it down into like almost like a quasi-democratic group conclusion about some of these investments. And you can fact check yourself. I imagine you can probably compare underwriting. I don't know how your community operates, but I can see the benefits, especially coming from the education space to where I have like a not aggressive kind of open dialogue about an opportunity that just came down. So I love it.
And there's so many different types of people in our community. Like we are very protective of the culture because, again, most of what we did for Left Field Investors, it was not intentional. We didn't build this we didn't create this great culture on purpose, but we have it and we're very protective of it. But what we also have is we have people joining our group who've invested in 50 or 100 deals and are full-time passive investors with a ton of knowledge. We also have people who are just trying to figure out, what is passive investing? What is a syndication? I heard about it. I'd like to get into a deal and test it out, right? So, and we have everything in between. And I set this community up thinking I would be teaching and educating and helping, and I've learned more than anybody. I am so much better at investing passively now than I was, 3 years ago when we started this group. And I've learned just as much from the person who comes in with 100 deals as the person who comes in and says, hey, I'm looking to get in my first deal and ask the question. I'm like, I never thought of that. Holy cow, that's great. So that's the beauty of the community, is that you can step in at any point and people are always willing to help. We have a forum where people can post stuff and it's, very collaborative atmosphere. And that's what I like about the community. That's what I like about real estate. Even when I was an active real estate investor, I was shocked at how much people were willing to help each other rather than compete with each other, right? Because there's so many assets out there. In fact, one of the things I did when I sold all of my active investments, I sold one of them to a buddy of mine who I knew he was going to double the value of that thing in a year. I just couldn't do it myself. And I sold it to him for, I doubled it doing nothing and not knowing what I was doing. And then, so I was happy, right? And then I sold it to him and he doubled it because he knows what he's doing. And I was okay. And he was okay. And that's win-win, right? And where can you can't get that in other places. It seems like real estate is really this community, whether it's passive or active, that you could really have some win-win situations. And I really like that.
I could not agree more. And I think one of the things that draws me back to real estate over kind of everything else is the level of control, the education, and the mentorship that's available. I mean, I'm not gonna dog the crypto bros out there, but it's like, what control do you have over Bitcoin and Ethereum? And I mean, and if people are into that, that's fine. I mean, I know a guy that's made a ton of money because he picked up Bitcoin at like, I don't know, a couple $100, and it's like, that's fine.
That's great.
But that's more like gambling to me. It's like going to Vegas in a way. You're like, okay, would I throw some money at Ethereum or Bitcoin or something? Maybe, but I would just presume it's like I'm on the craps table. You know what I mean? And it might go big, it might go nowhere.
You are, but the key is to know that, right? You have to know that. So what is the difference between Bitcoin and, the Wall Street, pick a Apple stock or Alphabet, right? What is the difference? It is speculation. And if you're speculating, as long as you know you're speculating, okay, great. But most people who are investing in the stock market think they're investing, right? I even just said investing. They're not, because what you're doing is you're buying a piece of paper or electrons now, right? Not even a piece of paper, and you are holding it with no current benefit, right? Nothing happens. You don't earn any income. Maybe if you have a dividend paying stock, you earn a little bit, but basically you're holding it for what? To sell it later to somebody else for more money, right? That's it. There's no current benefit. So that is the definition of speculating. It's the same with Bitcoin. It doesn't mean they're bad. It just means if you're going to be a speculator, do that. If you're going to be an investor, you need to buy real assets to produce a current benefit, right? In income. Or when you're doing development deals, they're saving up that current benefit and paying it to you later, right? You still get that benefit. It's just later. So for me, that was the light bulb when I'm like, I can't be a financial advisor anymore, because it is speculation. And for me, my finances, I speculate. I own Bitcoin. I own some startup companies. So 5 to 10%, yeah, that's speculation. All in. Great. All that could go to zero. But when I want to make money, I want boring real estate for 90% of my portfolio that's going to pay me cash now or pay me cash later, but it's going to be, an asset or real asset that provides me with a benefit. And that's the difference between speculation and investing to me.
Jim, you're dropping nuggets, man. I'm loving it. Okay. And I think what I'm noticing too is, like, I want to touch on something, because your depth of knowledge in, because your financial advising background in stock market versus real estate is probably deeper than my typical guest. So, will you jump into, really more for the audience's edification, some of how real estate investors are able to pay little to no tax? I think that question has come up a couple of times recently on our other forums, and I think you're a good man for the question.
Yeah, so there's the tax law is really built, as Tom Wheelwright, the famous tax guy, says, it's a book. The tax code is incentives, and the government incentivizes you to do certain things. And for whatever reason, they want people to invest in real estate, and so they make it pretty easy to have some tax advantages. So what I call it the lazy 1031, right? That is the strategy that I use. And I need to whisper this. I don't really pay taxes. I follow the tax code. I do what they tell me to do. And at the end, my CPA says, congratulations, you don't owe taxes. And the reason is, well, one, I don't have a W-2. It's very hard to do that when you have a W-2 job, because the government does not incentivize you to have a W-2 job. They do, but they want you to pay taxes if you have that. So lazy 1031, the best way I can explain this is, when I was switching from active to passive, right? I sold a bunch of active properties, and I was fortunate. I was a bad asset manager, but the market saved me. I made a lot of money on those. So I had a big tax hit, and I went to my accountant and I said, well, what do I do? And he said two things. First thing he said is, Jim, sometimes when you make a bunch of money, you have to pay a bunch of taxes. And I said, okay, I don't like number one. Let's go with number two. And he said, okay, well, you could do this. He calls it the lazy 1031 strategy. And basically what that is when I sell, I have these capital gains, right? But they're not like capital gains that you get from the stock market. They're passive. So it goes in the passive bucket. There's a passive loss and income bucket. So all I needed to do to offset that was have a bunch of passive loss. Well, where do you get passive loss? You get it in real estate, from depreciation, and when companies do cost segregation reports. So basically, cost segregation is just accelerating depreciation, right? So a typical asset might depreciate over 27 and a half years if you buy an apartment building. Well, the carpet and other things like that are going to depreciate faster on a 5-year or a 1-year term, because they will be obsolete faster, right? So cost segregation will itemize all that and give you a big bump. Well, they also, in the tax code, they have something called 100% or bonus depreciation, which allows you to take all of that in year one instead of the schedule. So what that does is, if I invest, say, $50,000 into an apartment building, I might get between 20 and 80% paper loss in year one, right? So let's use easy numbers. Let's say I invest $100,000 and I have 80% loss in year one. That means I'm going to have an $80,000 loss. Well, that property in year one, let's say I have a 7% return on that. So it's going to pay me $7,000. I won't pay tax on that because I have this $80,000 loss, but I got $73,000 of loss left over. Well, that can then offset the gains from properties that I'm actively selling. So what I did when I sold all those properties is I did it all in the same calendar year. That's important. I bought it into a bunch of syndications, ones that I knew would have higher than average paper losses, depreciation, and I was able to defer or eliminate all of my tax from those sales because of the lazy 1031 strategy. So then another little caveat here, when one of those passive deals goes full cycle and they sell, I will have what's called depreciation recapture, right? Which means if I got credit for 100% of the depreciation, but I only held the asset for 3 years. So I didn't earn all of the depreciation. So I have to pay that back. Okay. How do I do that? I take the money that I got when that passive deal went full cycle and I invested in a new deal that has new depreciation and wipes out my depreciation recapture, right? So it's like a 1031 exchange, except that there are fewer restrictions. It's easier. And as long as you do it in the same calendar year, you're fine. And the nice thing is if you get too much passive loss in 1 year, that rolls over until you can use it. So it's not an exact thing because you're never going to know how much loss you accumulated with your investments until the next year when you get your K1s. So it's not real targeted, but it is an effective way to eliminate and reduce your taxes. So what I tell people is get as much money from your W-2. If you transferred into real estate, then it's in a lower tax bucket. And that's where you want as much of your assets as you can have, because the number one eroder of wealth, taxes. If you can avoid taxes, your wealth is going to skyrocket.
Thank you, Jim. That was like a little seminar. And I think people here are like, oh, how does, Donald Trump not have taxes? And I don't want to go into his taxes. I think he had a long carried forward like bankruptcy loss. But to your point, the carried forward nature, right? It's still relevant. So like if you stack up, $1 million loss or a $500,000 paper loss, we're talking about, these depreciation or cost segregated, accelerated depreciation of short-lived items. What Jim's saying is this is how people are, I like the term offset or washout because I just think I don't know. I'm a history major, so I have to use basic words. I went to state school, but if you're going to like wash out or offset these gains or income, this is the way people are doing it. And I've done, when you consider asset classes too, like you don't depreciate land. So I've done some land deals where I'm like, oh, that's right. And the deal was good enough to where I still wanted to do it. It was a growth deal, right? But it's like, this, you can't depreciate land. So my only option is not the slow or lazy 1031. It would be the traditional 1031. And just I'll probably do a much poorer job, but so like in your normal 1031, let's say Jim and I buy, and people like to talk about apartment buildings. We buy an apartment building, we hold it for 5 years. We did the cost seg, the bonus depreciation. So we've really ratcheted up the depreciation. And so we've been paying no tax along the way. We sell it for a big old gain, let's say more than $1 million. Well, if we don't have a replacement property, so a 1031, we got to get the recapture on all that depreciation and the gain on that. Like I said, let's say it was $1 million upside in a sale. Well, that could really be the opposite of fun. And so what a lot of people will do, and this is not what Jim just described, but it's just as a corollary, they'll 1031. And as of right now, you can 1031 essentially an infinite number of times. And if you die in that 1031 cycle or chain, your heirs, and Jim will probably correct me, get a stepped up basis, and they're not going to have any tax on that recapture or gain that you've been deferring for potentially a lifetime.
Yeah. And and that's a great way to do it. Right. But again, bringing in Tom Wheelwright, I had him on my podcast and he said he hated the term lazy 1031 because it's not a 1031. So he doesn't want confusion. But he also said that, doing a 1031 exchange, you don't really need that anymore because of this strategy that I call the lazy 1031, which he doesn't like. What it does is Well, one, you don't have to constantly be upgrading and getting more debt and bigger properties like you do with the standard 1031, right? You always have to have a bigger property with a bigger loan to make this work. The other thing is you have to find a property and buy it when you within these certain dates. So there's pressure, right? When you sell, you got to make sure you buy. Well, with the lazy 1031, as you're a passive investor or an active investor, but I'm looking from the passive side, you're always stacking up these losses, right? So you don't have to worry about, oh, do I have enough to do this? I mean, in the first year I did because I had all those sales at once, but typically it just keeps on rolling. And so now the 100% bonus depreciation is being phased out 20% each year. So this year it'll be 80%, next year it'll be 60. But for me, I don't see that as a huge problem because where now I'm doing everything 100%, right? So I don't, one investment gives me all the paper loss in year one and nothing in year two. Now it's going to give me 80% of the loss in year one and 20% in year two. So I still get it. I just don't get it all at once. So as long as I'm consistent and I'm investing every year and having some, things go full cycle every year, it should balance out and still be a net benefit. And I should be able to still, defer tax and not have a tax burden.
And correct me if I'm wrong. I'm just kind of using some simple analogies. Your lazy 1031. Well, A, it's not a 1031. Let's be clear.
No,
B,
it's not.
But it's catchy. I like that title. You're really offsetting and washing, right? Because you're not stacking by comparison. Like with your 1031 traditional 1031 to 1031 to 1031, your point is well taken. You're kind of going into like bigger deal. And in particular, you want a lot of improvements, like small land, tall tower, lots of depreciation. Like,
yes.
So you go from like, maybe this garden style apartment, 1-2 story, and then maybe you finish with, 12 story in San Francisco. I'm being funny, but the point is you move down the asset ladder, it gets more expensive, and you want a lot of like improvement value, the building value, and then you're carrying this huge, by then it's going to be a multi-million dollar, potentially a multi-million dollar liability in that last asset. And God forbid, there's another risk in doing that perpetual. I'm not in this bucket. I do have one property that is the result. It's a replacement property. So it's in a 1031 chain, and I'd have to decide what I want to do if and when I sell it. But you don't run the risk of, some syndicators will bring on a 1031 as like a tick structure, so they could bring on 1031 money into their syndication. And I've thought about that, but I've also been told from some capital raisers, talk about pressure. You're negotiating this property, and here comes, let's say it's a big part of your capital stack, and they're like, Brownie boy, this is like 7 replacements down the line. You know how much recapture we have in this thing? You know how much gain we have? If you screw up this 1031 that we're bringing into your deal, due diligence issue, underlying debt issue to close the new property, whatever it is, that is a lot of pressure. And the lawyer in me thinks, like, depending on your agreements and your and the promises and agreements made, I don't want to be on the hook for any or a portion of, this, whether it's a family office or just an individual high net worth person, but to be on the downside of this long 1031 chain and have all of this potential exposure if you mess it up. What I'm getting at is this heightened pressure when you 1031 versus your lazy 1031, where you're really washing out gain and recapture with new properties with new depreciation. There you go.
Yeah, I think you nailed it. And the nice thing about the lazy 1031 also is you don't have to constantly think about it and be trying to match things to, the thing is, when you start out as in passive investing and you make your first investment, you are going to get a giant paper loss that you will not have the cash flow to offset, right? Let's say the person who has just one asset in this passive income bucket, right? They spend 50 grand on an investment and they get, $3,500 in cash flow year one, and they have $20,000 in loss in year one. Well, that $20,000 now is saved for later, right? And it'll offset all the distributions from that asset. But if you go buy another asset, now you got another big chunk of depreciation and nothing to offset it. So naturally, by the time you're 3, 4, 5 years into your journey as a passive investor, you've built up this huge bucket of loss that you can't use. And now your deals are starting to go full cycle. And now all of a sudden you start using that loss to offset And it's the golden hamster wheel, right? As long as you keep investing, you keep not paying taxes. And it's just an easier method. And you don't have this big, 1031 liability hanging over your shoulder either.
And not to, and we'll edit this out if it's too narrow, but the gain tax rate after you hold a property a year, and I think like the cutoff is around like 500,000 in income. Isn't it 15%? Does that sound correct? My point is it's like half of ordinary income. So, I mean, depending on your tax bracket, but just for the audience, and Jim will correct me if I'm wrong, as long as you hold the asset for a year and you're not a very high income earner, it's a long-term gain and it should be 15%. Is that correct, Jim?
I think that's right. There's some caveats there, and
okay.
Check your CPA. We're not.
Oh, certainly
financial advisors, but your point is correct. Like the highest taxable rate you can have is on the W-2 stuff, and that's bucket one, and then their bucket two is what they call portfolio income, which is stuff from like dividends from stock market and thing like that. So that's bucket two. What you want as much of your income to come into bucket three, because that's where you have easy offsets and you can offset things back and forth. And so that's where you want to be. And you're right. You also have lower tax rates because it's capital gains. It's not your taxable income, right? And income is taxed at the highest rate. So yeah, the more you can shift into those lower taxed buckets, the better. All
right. This has been awesome. So I'm going to pivot a little bit. With left field investors, where are you going to take this? It sounds like it started with a kind of a cool dinner and real estate investment conversation, and then COVID was probably I'm just putting words in your mouth. It sounds like it was a blessing because you went virtual, and virtual can scale, and here you are with over 1,000 members. So what does the future hold? What are some of your goals for left field investors?
That's a great question. We want to keep growing the community, not just to grow it for growth's sake, but our passion is to share this community personal finance option with people. People do not know that there are these private placement investments, general public. They don't know that these are options. They don't know that you can get 7% return tax-free and it's not a stretch, right? And that's just the cash flow, and then probably something more. So our goal is really to communicate this message, to share this with people so that people can understand, hey, there's other ways to build wealth. And for me and for many others, building wealth isn't about getting a bunch of money. It's about getting a bunch of time freedom. That's what I want. Everybody has their different reasons for building wealth. But for me, it's time freedom. It's location freedom. It's being able to do what you want when you want. And whether you love your W-2 and you just want to have this as an aside, or you hate your W-2 and you want to get out, what it does is this type of investing gives you multiple income streams, right? And multiple income streams are protection, because if you're a W-2 person, you have a job and that's it. You get fired, you have no income, right? But if you're a W-2 person and you have a job and then you have 10 investments and 10 income streams, you get fired, and it's not great, but you have 10 other income streams. So our passion is to share this idea, share all of this with whoever will listen. And to be part of our community, you have to be open-minded, you have to be willing to learn and to help others and understand. And if that's, and you got to be into finance too, right? And if that's you, then Left Field Investors is a great place for you to learn how to build your wealth and turn that into financial freedom, whatever that means to you. And that's our goal.
Oh, I love that. Yeah, it really is. It's like the high school teacher in you, right? And, right here on your one pager, high school finance teacher. So you've grown up and now you're spreading the message. And I'm sure in ways and avenues and mediums you never imagined, however many years ago you were in the high school classroom.
Right. Exactly right.
I'm holding back because I want to talk about teaching high school, but yeah, I don't think we have the time. I really loved it. It's like I really only left because my daughter, who's now 17, was born, and I just all the audience knows that teachers don't make great income. I was coaching football I think my coaching football stipend was like $1,300, and I didn't calculate the hourly because it just would have depressed me. I'm sure I could have sold watermelons on the side of the interstate and made more money. It was so.
Oh yeah.
But I loved it, and I coached track, and I did it for I coached 6 years, and I taught too. But ultimately, I went off into commercial real estate, starting with appraisal. But anyways, those were great days. I love to meet a fellow teacher like yourself. This has been awesome. We're going to do a little section that I call the Coach Brown Breakdown, and that's really resources. So an impactful real estate or business book that you would recommend to the group. And nowadays, some people, it's another podcast or an influencer or a YouTube channel, but on the resources category, hit us with a couple that were influential to you.
The Hands-Off Investor by Brian Burke is absolute must read if you want to be a passive investor. I think it's good for the beginner and it's good for someone who's advanced. It basically takes you through all different kind of metrics that you need to look at, how to analyze a deal, how to vet a sponsor. It's just a really quality book. Now, usually I'm not the best book reader. I get distracted and I get through like 2 chapters and then I bounce to the next book. This one, dog-eared, highlighted, written over. I took like 15 pages of notes. Fantastic book. Can't recommend that one enough.
Great. What do you do for fun when you're not out, preaching to the world the benefits of passive real estate investing?
Oh, I like to. In the winter, you can find me downhill skiing is a passion of mine, and in the summer, I like to play ultimate frisbee, and we bought a jet surf, which is a surfboard with a motor in it. That's awesome to tool around the lakes in. So that's what I like to do.
Is that one of the does it have a foil where you kind of come up out of the water, or is that a different thing?
No, I've seen those and I looked into those, and apparently those come with a detachable remote. And a lot of people, this is not funny, a lot of people lose limbs because they fall off of it and they don't let go of the remote, and the motor keeps going and hits you. So that was something we decided not to do. So we have the kind that just goes on the water and you can't get to the engine if you tried, but it's a blast. It's a lot of fun.
Yeah, it sounds very cool. And now you do that on lakes where you live?
Yeah, we do it on the lakes. Yep.
Yeah, I'm down here. I'm a river and ocean boy. So okay, that does sound fun though. I do surf, the old fashioned shoulder way. I might have to add a little motor.
Yeah, you can do it on rivers, and I took it out on the ocean once. But we were on the bay side. There's guys who take out on the lakes and do backflip, or the ocean and do backflips off the waves and stuff. That's not me, but I've seen it on videos.
We talked about goals. A man can dream.
There you go.
All right. Lastly, where can people find Jim Pfeifer?
You can find me at jim@leftfieldinvestors.com. That's my email address, or you can go to our website, leftfieldinvestors.com, and there's a contact us button. You can subscribe to our newsletter. You can join the Infield, which is our paid membership group if you want. So everything's out there on our website, and we're always happy to take calls. We take several calls a day from investors if they want to talk and learn more about our community. So there's a link you can sign up and talk to one of the founders, or you can, like I said, message me directly on email.
All right, guys. Jim has probably given us like 2 or 3 episodes worth of information here, and what's going to end up being probably less than an hour. So thank you very much, Jim, for coming on the show. Everybody's listening. This one is definitely worth a share, a rate, a review. Send this to somebody if anyone's ever wondered about tax implications of real estate, how to avoid taxes, how to be a passive investor, this community personal finance idea. I mean, there's some really good stuff in this episode. So make sure you share it, give us a little rate and subscribe. But for that's about it for the Yield Coach Show. I am your coach, Ian Brown, signing off and reminding everybody to lace up and leave it all on the field. Yield Coach out.